So there are people on both sides. It's not an either or. It's both sides believe that the government cooks the books in such a way as to rig data to tell you a story that's not actually true. And to a degree, yes. There's a problem, though, with the theory in that the private sector double checks. This is something that can't happen in communist countries. So, for example, when China tells you its economy is growing at 8%, you can't really believe that that's true. And there's no private sector report to prove otherwise. The private sector doesn't exist in China. Everything belongs to the Communist Party. So when the communists tell you there's 8% growth in China, you can look at the lack of growth with your own eyes, the flight of wealth into other markets, et cetera, the lack of stock market growth, and say this can't be true, but you don't know what it is. In this country, when the government tells you the economy is growing, what our government does is it uses survey data. And this is something I think a lot of people miss is, you know how you don't believe the polls? That's essentially what the government's doing, although in a little more detail. And in many cases, like I ran into this yesterday, as a matter of fact, the Bureau of Labor Statistics forces companies to provide data, whether they want to or not. You can get in trouble with the government if you don't. So by force of law, the government forces companies to hand over data. The government tracks that data and the government reports that data, but it basically uses statistical sampling just like everything else. And so it's only as good as the statistics. And then, yes, the government complicates things like, for example, people working full-time jobs. Now, starting with the Obama administration, the Bush administration did not do this. The Obama administration, to paint a more rosy picture of recovery, combined people working multiple part-time jobs. If they got up to 40 hours a week, said, look, this person's working full-time. Never mind they're working 2 or 3 jobs to get to 40 hours a week. They were classified as full-time work. That can only take you so far. For the last year, the government has been painting a rosy picture on the economy and the recovery post-COVID. The private sector data has not quite reflected the public sector data the full time. In large part, what the feds were doing was they weren't lying. They were just skewing the data. You know, there are lies, damn lies, and statistics. These were the statistics, and the government massaging the statistics. But again, the difference between our country and a communist regime is that you can only lie for so long in this country at the governmental level. You can only rely on statistics that are flawed for so long before the private sector data catches up with you. And we are now at the moment where the chickens are coming home to roost for the Biden administration, inconveniently for Kamala Harris before the election. This is from Bloomberg News. U.S. job growth in the year through March was likely far less robust than initially estimated, which risks fueling concerns the Federal Reserve is falling further behind the curve to lower interest rates. Goldman Sachs and Wells Fargo economists expect the government's preliminary benchmark revisions on Wednesday to show payroll growth in the year through March was at least 600,000 weaker than currently estimated, about 50,000 a month. While J.P. Morgan Chase forecasters see a decline of about 360,000, Goldman Sachs indicates it could be as large as 1 million. There are a number of caveats in the preliminary figure, but a downward revision to employment of more than 501,000 would be the largest in 15 years and suggest the labor market has been cooling for longer and perhaps more so than originally thought. The final numbers are due early next year. Such figures could also have the potential of shaping the tone of Fed Chair Jerome Powell's speech at week's end in Jackson Hole, Wyoming. Investors are trying to gain insight as to when and how much the central bank will start lowering interest rates as inflation and the job market cool. Once a year, the Bureau of Labor Statistics benchmarks the March payrolls level to a more accurate but less timely data source called Quarterly Census of Employment and Wages, which is based on state unemployment insurance tax records and covers nearly all U.S. jobs. The release of the latest quarterly census report in June already hinted at much weaker payroll gains last year. As it now stands, The Bureau of Labor Statistics data shows the economy added 2.9 million jobs in the 12 months through March 2024, or an average of 242,000 per month. Even if the total revision is as high as 1 million, monthly job gains would still average around 158,000, still a healthy pace of hiring, but a moderation from the post-pandemic peak. Now, again, this is important for you to understand, because I know we're all conspiratorial these days in how we think about these things and government cover-ups. So the Bureau of Labor Statistics uses statistical sampling each month to determine jobs hirings. They take surveys of employers around the country, they randomly sample, they produce the numbers. But then once a year, they look at the actual state level employments. Now, why once a year? Because not all the states have a uniform system. It's hard to compile the data through a uniform system. So it takes a long time to get that data. So they recompile every year and they adjust backwards to the March number to see what it actually is. It's a check within the system to make sure that the Bureau of Labor Statistics essentially is keeping itself honest. That's why it's hard to say this is a malicious conspiracy, because they then go back through and they look at the actual labor reports from the individual states based on unemployment taxes, and then you have the private sector on the outside also looking in. So the system checks itself to a degree to expose the potential for fraud and hanky-panky. What we're seeing right now with the data is that the number of jobs in this country have been going up. People have been finding work, but far less than what the initial data estimated. And when they revised the data based on the unemployment filings at the state level, they're going to revise down dramatically. Now, here's what complicates things. The Federal Reserve used to have one job. The job of the Federal Reserve historically has been to keep inflation low. The way the Federal Reserve keeps inflation low is multifaceted, but primarily by putting money into the economy or pulling money out of the economy, in large part through raising and lowering of interest rates. By driving up the cost of banks to get money, the banks pass along that interest rate plus some to make a profit. The higher the interest rate goes, the less people want money from the bank, the less money the bank takes from the government, the less money is in the economy, the lower the inflation rate. And based on economic conditions, that inflation rate can go up, that interest rate can go up, that interest rate can go down to affect inflation, which bounces around back and forth. When that was the Fed's sole job, it had a pretty easy job. You just move interest rates around, you try to affect the inflation rate, you will try to keep it at 2%. 2% allows for price growth over time, allows for growth in society, allows an economy without a whole lot of inflation. It's pretty stable. Problem is, over time, Congress decided the Federal Reserve needed a second job, and that was to maximize employment. The Federal Reserve position has always been that its number one job is inflation, the number two job is jobs. But occasionally, it's got to flip and say jobs are paramount. And guess what? In an election year, when you don't like Donald Trump, of course they're going to decide you got to put as many people to work as possible, even if it causes inflation. With the numbers coming in, the way they're coming in, they're going to have to cut interest rates, which might provoke more inflation. Remember, inflation is not yet at the 2% where they want it to be. But with the jobs numbers the way they are, they're going to have to do something. Now, how does this affect you and me? Well, one, they want to prevent a hard landing of the economy, which would be a recession. It's still looking more and more like we're going to get a recession. Two, they're going to possibly provoke inflation if they cut rates. They thought they had mostly cracked inflation. That's a problem. So let me get to this Bloomberg report here. The preliminary revision may reignite the debate over whether the slowdown in the labor market risks a more abrupt downshift in the economy. Employers substantially scaled back hiring in July, and the unemployment rate rose for the fourth straight month, while that contributed to a $6.4 trillion global market sell-off. The S&P 500 recovered. Markets, having recently experienced a growth scare that led to concerns that the Fed is behind the curve. We'll be monitoring Wednesday's release of the benchmark revision to see if the market's initial reaction was in fact correct, says Quincy Crosby, chief global strategist for LPL Financial. While other employment indicators have since reassured markets that the job market is on solid footing, policymakers are still highly expected to start lowering borrowing costs in September. So again, you got these two competing issues for the Fed. They have to manage interest rates, keep interest rates where it is to fight inflation, and they got to manage the jobs market. The data suggests that while hiring is continuing in this country, it's actually been at a far slower pace for the past year than the initial government projections were. This audit, and by the way, a lot of the data is because of California. You should know that. California itself has been messing with the data, not intentionally. California is just a convoluted Kafka-esque state in the way it handles and reports its data. It's complicated to get anything out of the black box California data. Yes, do they manipulate data in California? Absolutely. But it also bears out that in California, because of the increase in the minimum wage to $15 an hour, they're seeing a big decline in hiring rates, and they're seeing an increase in layoffs because the California market is problematic. Around the country, it's not as bad as in California. However, it is bad around the country. And here's the other thing you got to remember. Remember that clip I played yesterday, if you were here? Don Lemon went to Atlantic City, was interviewing people. And a man tells Don Lemon, 4 years ago, I was making more than I'm making right now. And Don Lemon says, if that's not true, the data says it's better now. The data says it's better now versus what the man says is his lived experience. For the last year, the American media has lectured every American about the data. The data says your life is not as bad as you're telling me your life is. Therefore, I don't believe you about your experience. I believe the data. Turns out the data has been misleading. The data has been off. So the American Press Corps has lectured you about your lived experience, that your lived experience doesn't match the data. Therefore, you must be lying. And it turns out the data has been wrong. Actually, hiring's been far less robust and the economy's been moving far slower than the government said it was, and the private sector has exposed the data. It's now going to be revised, and every single member of the media who lectured you that you're better off than you were 4 years ago and your lived experience is a lie if you don't correspond to the data, the media has been misleading and bullying you into saying the economy's better than it actually is. It turns out, just like COVID, you're right. The experts are wrong, and the media has another black eye for daring to lecture you about your own life.